Welcome back to the Bull and Bear Brief, your clear, no-spin breakdown of what's really moving markets. Today, I'm diving deep into the US economic cycle, what phase we're in, and where key asset classes may be heading. Let's get into it. Right now, the US is in a mid-cycle expansion. That means we're past the early recovery stage but not yet close to a slowdown. Employment, still strong. Consumer spending, surprisingly resilient. Inflation, it's cooled off since those wild peaks in 2022 and 2023, but it's still running hotter than the Fed's 2% target. So for now, monetary policy is basically on pause and any rate cuts, those depend heavily on whether disinflation keeps rolling. Looking globally, the IMF's calling for 3.3% growth in both 2025 and 2026. That's a little below the pre-pandemic average of 3.7%. But there are definitely risks out there: rising geopolitical tensions, trade frictions, and a drop in consumer confidence across advanced economies. In emerging markets, it's a mixed bag. China's growth seems to be stabilizing, while a lot of commodity exporters are slowing down. So what does this mean for asset classes? Let's break it down. Equities, I'm seeing modest upside. Corporate earnings are still growing, but they've lost some steam. Valuations are a bit stretched, so watch for sector rotation as investors swap between defensive and cyclical names. Government bonds, I think there's room for slight gains. High starting yields and possible Fed rate cuts could lift long-duration treasuries. Plus, bonds are a classic safe haven when things get bumpy. Corporate credit. Here, I see selective opportunities. Spreads may tighten as everyone chases yield, but there's a real divide. Investment grade is solid, while high yield faces more risk if growth slows. Commodities, it's a mixed bag. Energy markets react to Middle East headlines, industrial metals depend on China, and agriculture's tied to weather and supply chains. Gold, mild upside. It's still shining as a store of value, especially with so much policy uncertainty and low real rates. Real estate facing headwinds. Higher borrowing costs are squeezing commercial real estate, and home markets are cooling in a lot of areas. The US dollar, I see slight weakness ahead. Policy moves by other central banks and shifting risk sentiment could put some pressure on the greenback. So here's the big takeaway. The US is in mid-cycle growth, propped up by a strong labor market. Equities and investment-grade bonds might offer modest returns. Credit spreads may tighten but stay selective. Commodities are a mixed story. Gold stays a useful hedge. Real estate is under pressure and the dollar may drift a bit lower. Bottom line, a balanced strategy tilted toward quality assets and with enough liquidity fits best in this part of the cycle. Now I want to hear from you. What's your take on the current cycle? Are you leaning into equities or playing it defensive? Drop your thoughts in the comments below, and don't forget to like, subscribe, and hit the bell so you never miss another episode of the Bull and Bear Brief.